If you want to become a millionaire before you're old, you need to do 3 things in this order. I'll show you. Step number 1, run the numbers. Let's start simple. You take your extra money and you save it under a mattress. How long is it going to take for you to become a millionaire? Well, if you save $10 a day, that's $3,650 a year. It will take 273 years to save your way to $1 million. If you save $50 a day or $18,250 a year, now it's going to take you 55 years to become a millionaire. And if you save $100 a day or $36,500 a year, it's going to take you 27 years to save up $1 million. This is why I always say you can't save your way to wealth, because number 1, your money is not growing when you save it under your mattress, and number 2, in 273 years, $1 million probably won't buy you that much stuff. So let's take this one step further and assume now, instead of saving this extra money, you invest this money and you get the average market return of around 10% a year. Now, how do the numbers change? If instead of saving $10 a day, you invest $10 a day, well, now it's going to take you 35 years to become a millionaire, a whole lot less than before. If you invest the $50 a day, now it's going to take you 19 years to become a millionaire. And if you can invest $100 a day, well, now it's only going to take you 14 years to become a millionaire. But I want to take it one step further. Let's assume that you invest in your financial education. You're investing in your investing research, and now you can start to make a little bit better returns. Not anything crazy. We're not talking about 100% annual returns or even 20% annual returns. We're talking about just a little bit better than what's average, because you now are investing in your education and your investment research. If you can average a 13% annual return, how do the numbers change? If you're investing just $10 a day, it'll take you 29 years to become a millionaire. If you're investing $50 a day, it'll take you 17 years to become a millionaire. And if you can invest $100 a day, now it'll take you just 12 years to become a millionaire. Now that we've run the numbers, let's move on to step number 2, finding where you can actually get these types of returns. Now, to really understand how to grow your money smartly, you have to understand risk versus reward. So let's go through an example. Let's assume you have 2 investment options. Investment option number 1 is you can save your $10,000 in your savings account in your bank that's FDIC insured. Option number 2 is you can take that $10,000 and lend it to your broke cousin Bunty on his 14th business idea. Which one is riskier? Well, it's riskier to lend your money to my broke cousin Bunty because he's not very good with money. If I deposit $10,000 in the bank, I get a receipt that I have this $10,000, and even if the bank collapses, well, it's FDIC insured, which means the government is guaranteeing that I'm going to get this $10,000 back. So it's a lot safer for me to save my money, which is why the return that I'm going to expect on my savings is a whole lot lower. Maybe I'll get 1%, maybe 2% or 3%, maybe 4% if I go to a high yield savings account, but it's just a few percent, if that, if I put my money into a savings account. If I invest my money in broke cousin Bunty, I would not be happy with the 4% return. Either I'm going to turn my $10,000 into $10 million, which is probably not going to happen, or I'm going to see none of my money back. So it's a lot of potential return, because I would not lend my money to him unless there's some crazy possibility that he builds the next Apple or Amazon. But if it's not that, I'm not going to lend him my money. Lucky for all of us, we have more than just these 2 investment options. And in the middle of this risk and reward calculation, we have investing in stocks and investing in real estate. These 2 asset classes have proven the test of time. They've been around for hundreds of years as an investment, and they have provided decent returns for the financially smart investors. Over the last decade, the stock market has averaged more than a 10% return a year, and with real estate, it's more or less the same, because when you factor in rental income, the average real estate return for the last number of decades has also averaged a little north of 10% a year. But it's a whole lot easier said than done, so let's move on to step number 3. How do you actually get these types of returns? Now, this is where I do want to remind you that my team at Briefs Media publishes a free daily newsletter called Market Briefs, where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and the global markets into a fun, witty, and easy to read newsletter. It's read by hundreds of thousands of investors every morning. Plus, when you join Market Briefs, you'll also get access to an investing masterclass where I'll show you how you can start investing and find hidden investment opportunities before everybody else. It's completely free. So if you want to get my investing masterclass plus Market Briefs, All you have to do is click the link down in the description below. So the stock market averages 10% a year, but what happens if I invest my money into the next Sears and a company goes bankrupt? Then I lose all my money. And so this is where you have to know the different ways that you can invest your money in the stock market, and you can invest your money into an individual company like, say, Amazon, AMZN. But when you do that, you're carrying on all the risk. Now you have to put in the work to analyze the stock, keep up with the company, see if the company is growing. And if Amazon does very well, you get to see the profits because now Amazon stock will go up and you can get rich. But if Amazon doesn't do good, and Amazon starts producing bad products, and they manage their cash poorly, and they have a bad CEO, well, now the company could go bankrupt, and now you lose everything. And the question is, do you want to be involved in putting in all the work, effort, time, and research, or would you rather invest your money more on autopilot? I'm not going to decide for you. Both of them are great, but what I want you to understand are the different ways that you can invest your money, because a lot of people think that investing in stocks is trying to find the next Amazon, and that's why most people end up losing money. But the real opportunity for so many people isn't by trying to find the next Amazon, it's just by owning a piece of the United States economy, because there are funds out there that will give you exposure to the American economy, and we know that the American stock market has grown by 10 to 12% a year for the last number of decades on average. I'll show you what I mean. Instead of investing in Amazon, another thing that you can consider is something like VTI. VTI is an ETF created by Vanguard. Vanguard is a money manager, and this is an ETF that gives you exposure to the total stock market, which means if you go onto your stock brokerage app, there's a ton of them out there, and you buy one share of VTI, you're buying a little piece of all the stocks in the American stock market. You're buying a little piece of thousands of American companies. Now, you're not trying to pick the perfect company. You're not trying to time the stock. All you're doing is you're buying pieces of the American economy, and if the stock market goes up, VTI will go up. If the stock market's going down, VTI will go down. We know markets go up and down, but if you hold on to this for the long term, we know that markets generally go up over the long term. But let's assume you don't want to be so broad. You want to be a little bit more narrow. Another example here is SPY. SPY is an ETF that gives you exposure to the S&P 500. You may have heard that term before. The S&P 500 is a group of the 500 largest companies in the United States stock market. So now, instead of going out and buying all 500 of those companies, you can just buy one share of an ETF like SPY, and it'll give you exposure to those 500 largest companies. Now, if Amazon, who was part of the S&P 500, starts to struggle and they're no longer part of the S&P 500, well then SPY and the other ETFs would kick Amazon out and replace it with another company. This way you don't have to worry about managing the fund. It's managed through the fund. You find the right fund and then it will manage the stocks for you. Now, I do got to give a little disclaimer because investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence and never blindly trust a random guy on YouTube. Everything that I talk about is for example purposes only. But let's take this one step further, assuming you want to get even more granular. Let's assume you're like me and you like investing for cash flow. In the stock market, some companies pay out dividends. A dividend is a cash payment that a company gives you for doing nothing except owning the stock, and generally they pay you this money every 3 months, meaning every quarter. Well, there's an ETF out there called Noble, N-O-B-L, that gives you exposure to dividend-paying companies in the S&P 500 that are dividend aristocrats. What does that mean? Number one, they are in the S&P 500, meaning they are a part of the 500 largest companies in the stock market. But it's the ones that are paying out dividends, meaning the ones that are handing out these profit distributions every quarter, but they're also dividend aristocrats, meaning that they've been paying out dividends every year and increasing their dividends for the last 25 years or more. And now I'm going to take it one final step further. Let's assume you want to get more granular with your investments. You don't want to invest in the broad economy. You want to invest in the growing elder population in the United States, because you assume that because baby boomers are getting older, there's going to be more money going into that elderly care field. Well, there are also niche ETFs out there that can give you exposure to really whatever you want. This is just a random topic that I picked, and there are ETFs that can give you exposure to those niches. For example, aging, AGNG, is an ETF that gives you exposure to the companies that are providing care to people that become older. So as more people become older, certain companies will profit. This ETF invests in those companies. So when you want to invest in the stock market, you can invest in individual companies, or you can invest in funds that pick the companies for you, And now you can decide if you want to be broad in the total stock market, broad in the S&P 500, broad in dividend paying companies, or very niche. But I can't talk about investing without talking about real estate because I got my start in the investing world in real estate. And the way real estate investing works is you're gonna go and buy a property. Let's assume a single family house, but now you're not buying it for you to live in, you're buying it to rent out to somebody else. And the mistake that a lot of people make is they assume that they're gonna have to pay money out of pocket every single month to own this property. But if you do it correctly, the way it works is you're gonna buy this property and then have a tenant move in there. Now they're a happy family because they get a nice place to live, and in exchange, they're going to pay you rent every single month. And now when they pay you rent, if you do it correctly, this rent is gonna pay for all of your expenses, your property taxes, your insurance, your maintenance fees, your management fees, and your vacancy costs, and then put some money in your pocket as cash flow. Now, you might think that this is going to be extremely difficult. Well, it is when you get started. But after you get over the hump of learning the game, it can be a lot more passive. The first few years of me getting started in real estate was extremely difficult, extremely time consuming, and very stressful. But after I learned and after I found the right team members, now it's very passive on my end because I have a very good property manager. They're giving me reports every single month. I can see in real time which properties have been paid rent, which properties are behind, what maintenance has to be due. I can see everything in real time. But it takes time to learn the game and to learn how to do it profitably. But the nice thing about real estate is, number one, you can get this monthly cash flow because when you start stacking properties, well, now it starts to add up and you can live off of that cash flow. Number two, you own a hard asset because I own properties that I can see, feel, and touch. I own the land, which is nice because when I own a share of, let's say, Amazon, I just have a piece of paper that says I have a share of Amazon. I can't actually do anything. If I walked into the Amazon factory, well, nobody would know who I am. And then number three, with real estate, you also get some of the biggest and best tax breaks that our tax code has to offer. As a licensed attorney, who's not your attorney, what I can tell you is that wealthy people love real estate for the tax breaks because when you invest in real estate, you can make money and pay little to no money in taxes legally because of the deductions that you get as a real estate investor. I'm not going to go over the real estate tax laws in this video. I have other videos on my channel where I go over them. I'll also link one for you down in the description. But what I want you to understand is that real estate is powerful beyond just the cash flow that you can get. Now that you understand how to do it, let's talk about step number 4, executing. Everybody talks about how great investing is, but nobody talks about the time it takes. But here's the thing. With investing, the more money you have working for you, the wealthier that you can become. Take a look. Let's stick with the most basic example. Let's assume that you're investing $10 a day and you can get the average market return of 10% a year. It's going to take you 35 years to make your first $1 million. But then to see your net worth grow from $1 million to $2 million, that's not going to take you another 35 years. That's going to take you just an additional 7 years. And then if you want to see your net worth grow from $2 million to $3 million, that's only going to take you an additional 4 years. And the reason why is because you have more money working to compound and grow. This is why it's so important for you to start sooner rather than later. The reason why so many people don't get to where they want to go financially isn't because they made the wrong investments, it's because they didn't get started. And the key to becoming wealthy and building that wealth isn't to make the right investments, it isn't to make the perfect investments, it is just to get started. And that's why the key to success is to take that first step. Now you're gonna lose money, you're gonna make mistakes, things will go wrong. It's a part of the process, but you gotta get started and make those mistakes. That way you can get to where you want to go. I call it a decade of sacrifice because you're going to have to go through a decade of crap, of spending less money, working to earn more money. That way you can invest your money like crazy. And if you can stick with it through that decade of sacrifice, well, now you will have the ability to actually build wealth. And what I want to remind you here is that when we talk about these average returns of 10 or 13% a year, this does not mean that the markets go up every single year by 10% a year, because market crashes happen. Recessions happen. We've seen the markets go up and down many times. But despite that, over the long term, we have seen markets always go up. And that's the thing that you want to remember. Most people panic when markets go down, whether it's because of tariffs, whether it's because of a recession, whether it's because of a pandemic, people panic. But what we've seen happen time and time again now, decade after decade, century after century, is that markets go up, markets go down. the financially savvy that understand this are able to build huge sums of wealth. Again, this is where in my investing masterclass, I talk about this so you can find the opportunity and the craziness. If you haven't seen it yet, you can click the link down in the description. And finally, this brings me to number 5, reinvest. If you want to get to that $1 million number even faster than everything you see here, there's 2 things that you can do. The first thing that you can do is when you start here, work to increase how much money you invest every single year. You can start with $10 a day, but then when you get a raise, maybe bump it up to $15 a day, then $20 a day, then $25 a day. That way you're constantly working to invest more money. As you earn more, you invest more. And if you can find extra money to invest, well, the faster that you can become wealthy. The second thing that you can do is work to reinvest some of your profits. So if you're investing in the stock market and you get paid with a dividend, you have 2 options. You can take the dividend and spend it, or you can take the dividend and reinvest it to buy more shares of that company. And if you want to build that wealth faster, well, you got to make some more sacrifices and reinvest that money. And now you have a machine where you're working to earn money. That way you can buy this thing that produces cash flow. And as you earn more money, you're buying more of this cash flow printing machine. But then as this machine prints you cash flow, you use it to buy even more cash flow. So it's the game. You're working to earn money to produce cash flow, and the cash flow buys you more cash flow. And then eventually, when you have enough cash flow coming in, now you can start living off the cash flow. Same thing with rental properties. As you start to make the money from real estate, you can work to take that extra money and reinvest it. If you don't have enough money to buy another property, you can take that money and reinvest it into the stock market. That way it's a constant cycle of making money, investing it, and then use your investment money to make you even more money. That compound interest is what can allow you to accelerate your wealth even faster. But the key is to get started. Start by running the numbers. Understand, stocks and real estate have proven the test of time. Learn how to do it. Invest in your education. Invest in your research. That way you can make smarter investments and then stick with it and execute. If you have $100 in your bank account and you want to buy this $1,000 Gucci scarf, your bank would love to lend you the $900 at 25% APR, because when you make the minimum monthly payments, your banker gets richer. But that's just the beginning. When it's time for you to buy a house, who do you ask? How big of a house should I buy? Many times it's your banker, and they're not your financial